here we go. Finally. All right, sorry. Okay, so let's breeze through the first part of chapter 3, and I'm going to record this so that we can have it later. All right, so chapter 3, of course, is just a review of your Accounting 272 class. So there's the accounting system. Of course, we know that it's just a system to record, organize, summarize, and report information useful to investors, creditors, and other external financial statement users. It's a system of recording transactions in such a way so that facilitates our being able to produce financial statements and other useful reports for internal and external users. How's that for a definition? That's what accounting is. So we learn the language so that we can produce useful information from it. All right, let's see. So there's the accounting equation. Everybody knows that, right? Assets equals liabilities plus shareholders' equity, or I always say owner's equity, because if we say shareholders, of course, we're only talking about a corporation. And I like to make clear the point that our accounting system is applicable to not only corporations, but also sole proprietorships, partnerships, LLCs. So that's why I call it owner's equity rather than shareholders' equity. But of course, you know, if we're talking about a corporation, those two terms are interchangeable. Okay, we know revenue, everything is that the company earns, and revenues are recorded as they are earned, not as they're collected. So, and remember, we talked about the definition of accrued revenues. What's the definition? Everything that has been earned, not yet received. Very good. Accrued expenses. Expenses are recorded as incurred. Accrued expenses are ones that have been incurred, not yet paid. Good. So therefore, the entry to accrue revenue is always what? Debit to a receivable account, credit to revenue, because you are recording revenue that has been earned, not yet received. The entry to accrue expenses is always a debit to an expense, credit to a liability, right? Because you're recording expenses that have been incurred, so therefore they need to be debited to an expense, and they have not been paid, so therefore they need to be credited to a liability. Okay, so that's always the entry.
How do you find a liability?
What is a liability? It's everything that is owed by the company to outsiders. All right, and then of course we don't necessarily talk about gains and losses when we talk about the accounting equation, but gains and losses happen when we sell a long-term asset. So if we sell it at greater than book value, what's book value of an asset? What's the formula? Cost?
Minus salvage.
Divided by estimated value.
No, that's depreciation. What's the formula for a book value of an asset? Cost minus accumulated depreciation. Very good. Okay, makes sense. What's book value of a business? Very good. Assets minus liabilities. All right, good. All right, so you need to know these things. And the things that I think you need to know is the ones I'm going to repeat over and over and over and over. And you need to learn those things. All right, so revenues is recorded as earned, expenses are recorded as incurred. Gains and losses is only when we sell a long-term asset. So if we sell it for greater than book value, it's a gain. If we sell it for less than book value, it's a loss. And of course, we're going to have to record those. All right, transaction, of course, that's an exchange of resources between the company and any other party, including the owners, right? Remember that business entity concept says that the business is actually separate and distinct from the owners. So when the owner contributes money into the business, that's a transaction. There's an exchange of resources. The owner purchased ownership in the business. Of course, if we're talking about a corporation, shares of stock in exchange for money. Right? So that's a transaction. So there's an event, an occurrence that affects the company. We don't need those. Okay, and of course we know what an account is. We have a chart of accounts that lists all the accounts that we use in our business. So for what we're trying to determine, we know we need a debit and expense account, but we don't know which one. We would look at the chart of accounts to see what the company uses, what is their policy. Yes, sir.
Does that mean I didn't finish the chapter 3?
We didn't finish it. We got up to slide 27, but I'm just doing this on recording. Okay, just so that somebody wants to watch it later, because this is a review of 272. So I wanted to get a recording of it. Okay, and then of course the T account looks like a big T, right? What's the song? Debit, left, credit, right, debit, left, credit, right. So all the debits go to the left-hand side, credits go on the right-hand side of the T account. And of course, we're going to summarize that total of the T account, add up the debits, add up the credits, take the difference. If the credit side's larger, then we say it's a credit balance account. If the debit side's larger, it's a debit balance. And of course, we're going to take that, throw it onto the trial balance, right? What's the purpose of a trial balance? We try the accounts to see if they're in balance. So anytime we post to the accounts in accounting class, we represent that by a T account. But in the real world, it's all done by a database. So all we actually do is take all the transaction database, and I know this because I'm a programmer and I wrote my own accounting system software for my office about 30 years ago, actually 33 years ago. All you do is you take the database of all the transactions and you just sort it by account number, and bam, you can print out a general ledger. So we don't have to go through the hassle of posting from the ledger over to a T account. It's all done electronically within seconds. So we learn how to do it in accounting class just because accountants have to be able to set up software. So you have to be able to set it up, and you need to understand that process that's happening inside of the computer, just in case you want to be a programmer, or you buy a new software package, you need to know how to set it up. Or in my case, sometimes I have clients that will hire me to come in and set up their accounting system for them. So just an opportunity to make more money, right? And that's what it's all about, is making jack. Okay, so a T account just represents the ledger and what that looks like inside the computer system. Okay, we talked about permanent accounts and temporary accounts. What are the permanent accounts?
The ones that never close out. Ones that never close out.
Ones that never close out. What are they? Assets, liabilities, owner's equity. The capital account never closes out. The retained earnings account never closes out. So what are the temporary accounts?
Expenses,
right,
dividends.
Revenues, expenses, and dividends. Good. Okay, does that make sense? So they're called real accounts or permanent accounts. So all the balance sheet accounts are real accounts. Assets, liabilities, owner's equity, which breaks down into common stock and retained earnings. Those are our real accounts. And then the temporary or nominal accounts are the revenue or the income statement accounts and the dividends account. That's the ones that get closed out with the closing entries. So what are the closing entries? So if we had to manually, of course, in my computer system, you just hit a button that says close accounts. Bam. And you tell it what account number you want to close it into, which is the retained earnings account, and what period of time you want to close the entries for. So if you put January, December to December of 12/23, and we tell it to put it to the retained earnings account, the computer just makes all the entries for you, because if you have a good programmer, you can do that, right? And that's why somebody pointed out, isn't accounting going away? Bookkeeping could go away. Somebody's got to still set up the bookkeeping system, so they have to understand the process enough to be able to set up the bookkeeping system. But just bookkeepers are probably not going to have a job in the future. Somebody's got to key the transactions into the computer system, so you could call that a bookkeeper. But so much of that can be done electronically as well. So for example, when I wrote my accounts receivable system, I wrote a general ledger system to be able to do financial statements. You can key in transactions, and you can print out reports and balance your bank account and all that stuff in the general ledger system. But when I wrote my accounts receivable system, you can key in an invoice to a customer, and you pull up the name of the customer that you want to key the invoice to, put the date, the amount, what they purchased, and then that whatever they purchased can eliminate the inventory. So we can go out to the inventory system, get your cost of goods, So it can record the sale and the cost of goods sold entry over in the general ledger system. Okay, so you don't have to record those transactions over there. In the accounts payable system, you can key in an invoice. It's going to debit whatever expense account or asset account or liability account that you're actually paying and credit cash. It can make that entry for you in the accounts payable system. So you just key in the invoice and the computer, it'll print out the checks for you and it will make all those entries for you. You can put in your repetitive transactions like your depreciation entry that you make the same every month, and it can make that entry for you. So all that can be done electronically, but somebody's got to know how to set it up, right? So it's true that bookkeeping could become a thing of the past, but somebody's got to understand the system. So a good accountant does understand the system, because if they say, can you come and help me set up my bookkeeping system, and you don't now know how the thing works, you're not going to be able to do it. Okay. And then, so what if there's an error? Somebody's got to know how to fix the error, right? So I don't think bookkeeping is going away, but bookkeeping as a job could. But accountants have got to understand bookkeeping. Okay. So when in my system, when you hit the button that says close the books for that accounting period, what's the entry that it makes? So we got to close out the revenue accounts, the expense accounts, and the dividend accounts. Revenue accounts, normal balance is what? Credit.
So you're going to debit it.
So you're going to debit it, exactly. So whatever the balance. Now, if for some reason you do have a debit balance in a revenue account, which should be very rare, right? But it could happen, maybe some kind of an error or some kind of correction from a previous period. So whatever the balance is, you're going to do the opposite in order to close out that revenue account. So like we said, normal balance is credit. So we should be debiting all the revenue accounts and credit to retained earnings. Okay, does that make sense? That's the entry to close it out, because the permanent account is retained earnings. So revenue gets closed into retained earnings. So debit revenue, credit retained earnings. Expenses, normal balance is debit. So all the expense accounts should have a debit balance. So we're going to credit them and debit retained earnings. Exactly. Dividends, normal balance is debit. So it's going to have a debit balance. We're going to credit it to make it go to zero and debit. Exactly. Okay, does that make sense? Good. All right, so you know how to make the closing entries. Then, of course, all the temporary accounts are closed out, and then you can do a post-closing trial balance, right? What accounts are going to be left on the post-closing trial balance? Post meaning after. Good. Assets, liabilities, owner's equity, just the real or permanent accounts. Good. Okay, we know what a contra account is, right? Who can give me an example?
Wait, and capital reserve, or does they also get those out in?
No. Those are part of owner's equity, so they're permanent accounts. Capital on owner's equity, or capital and retained earnings are permanent accounts. The only ones that get closed are the bottom ones, revenue, expenses.
Yeah, but do they go under owner equity, or would it be the owner account, capital, and retained earnings?
Well, they go into owner's equity, they go into retained earnings. And retained earnings is a permanent account.
Oh, that's going to be
on the balance sheet.
On the permanent.
On the post-closing trial balance? Yes. Yep. All the balance sheet accounts. So, retained earnings is a balance sheet account. Yep. Good question. Okay, what's a contra account? Give me an example. What's contra mean?
Opposite.
Good. Opposite, accumulated depreciation, most common one, right? And what that does is, because we have the historical cost principle that says fixed assets have to be recorded at historical cost. So if we have a building or a piece of equipment or a delivery truck, it's got to be on the balance sheet at historical cost. But recognizing the fact that a $100,000 big rig is not going to be worth $100,000 forever, right? Because we're using it up. We use a contra asset account, accumulated depreciation, to reflect the fact that it is going down in value as we drive the wheels off of it, right? Okay, good. So what's another contra asset account? What about accounts receivable? What value is it recorded at? Net
realizable value.
Very good. Net realizable value. What does that mean?
Must be realized value.
how much we will collect or realize from that accounts receivable. So recognizing that humans being humans, not everybody's going to pay you, right? So accounts receivable is recorded at historical cost. All of the invoices are recorded in the accounts receivable account, but we use a contra accounts receivable account called allowance for doubt.
Allowance for doubtful.
Good.
Yeah.
Good. Allowance for doubtful accounts. So doubtful that they're going to be collected, right? So we're allowing for the fact that some of those accounts are not going to be collectible. So the two of them together, accounts receivable and allowance for doubtful accounts, should reflect the net realizable value of our accounts receivable. So that's a contra asset account. Good. Okay, moving on. Financial statements, of course, we know income statement, balance sheet, statement of retained earnings, statements of cash flows, and we're going to do some of those. All right. So accounting cycle we talked about. We record the entries, we post them into the ledger. We do the adjusting entries, which is accruals, basically, right? Accrued revenue and accrued expenses and depreciation. Those are our adjusting entries. And we're going to do some of those. Okay, everybody knows what a journal entry looks like. You put the date at the far left. Of course, when you're keying it into a computer system, my system asks you for the date of the transaction, then it asks you for a description and a source code. In my system, I like to put source codes. If I wanted to pull out all the cash disbursements, then I can print a report with all of the source codes. Or if I want to print out all the payroll entries, and we didn't talk about that. In my payroll system, when you key in the hours to pay the employee, of course, it knows all the information about the employee, right? What filing status, what their rate of pay, and all that information, any deductions that they want taken out of their paycheck. And it actually writes the paychecks and produces the journal entry that goes over into the journal. So it debits wages, credits all the appropriate liability accounts, and credits cash to pay the employees. Okay, so all that is done automatically by the payroll system, so we don't have to make payroll entries. Okay, so in my general ledger system, if I want to key in a journal entry like this, it asks you for the date. It asks you, so my point was my source code for that would be PR. So if I wanted to look at all the payroll entries in the ledger, I could just tell it, I have a report set up. I can tell it to print all the PRs for whatever period of time, and that way I can look at all those entries. So if I'm looking for something, then I can actually find it by looking at that particular code. So accounts receivable entries would be AR, accounts payable entries would be AP. Okay, so that's just another means of being able to search the database and look for whatever information I'm looking for. Okay, does that make sense? So it asks you for a description. So like issued 2,000 shares of no par common stock or no par stock. That would be the description. And then of course, what account do you want to debit? What account do you want to credit? And then bam, computer system takes that entry, dumps it into a transaction file. And if you want to print out a journal, a ledger, there's no need to post. When you put it into the journal, it posts it into the ledger. And if you want to look at all the accounts, so I have one option that says account inquiry. So if I want to look at all the entries in the cash account for a range of time, I just say, what account do you want to look at? What beginning date, what ending date? Bam, right there are on the screen. If I want to look at all the rent expense accounts, key in the account number for rent expense, beginning date, ending date, bam, right they are. Okay, it's all electronic. So it's just one big database of all the transactions. If you want to print out an income statement, you choose the option to print out an income statement. Bam. What date do you want? You put in the dates, it prints out an income statement. So so it's all done electronically. And the only time I've ever done accounting manually is in class, about 100 years ago or so. Okay. Other than that, all been electronic. I've never used the big green sheets or anything like they did back in the day. When I was in high school, we had big green sheets that you did your accounting stuff on. Did you have that? Okay. Okay, so this is what an entry looks like, but of course, electronically, we're not too concerned about it because we're not going to record it this way anyway. But of course, when I write transactions on the board and when you write them on an exam, you're going to say debit to the left, credit on the right, so you're going to slightly indent your credits. And typically we list our debits first, credits second. I don't get bent out of shape on that. Don't give a shit, because electronically, computer's just going to sort it. It doesn't matter. Okay? And you're going to put debits in the left-hand column, credits in the right-hand column. And of course, electronically, you're going to put an amount either in the debit space or the credit space, and the system won't let you do both. Okay? All right. Does that make sense? So you know the proper format for journal entries. Okay, don't care about that. So that's what a T account looks like with all the entries posted in it. Okay, we talked about trial balance. Okay, adjusting entries. So the reason we need adjustments is because of deferrals. Sometimes we need to defer recognizing something as revenue, or defer recognizing something as expenses, or accruing revenue or accruing expenses, or recording an estimate like depreciation. So you know, when we record depreciation expense, that's just an estimate. So when we say that this delivery truck depreciated $1,000 this month, that's just an estimate, because we didn't appraise the truck to see how much its value actually went down. So what we do is we estimate how long that truck is going to be of value to the company, and we have a formula for calculating it. That's the beauty of accountants, is that we have methods. We know the methods for estimating costs, so that we can produce financial statements that are useful in business. So if we were to use straight line depreciation, okay, that's one formula, but of course we're going to learn all the depreciation methods in this class, and there are actually several, and we're going to learn all those methods. But if we chose straight line depreciation, what's the formula? Useful life. Very good. Cost minus salvage value divided by estimated useful life. So for example, if I had a $50,000 delivery truck, and I estimate it's going to be of value to me for 5 years, and it has no salvage value at the end, so it's going to be $50,000 cost minus 0 salvage divided by 5 years, or 60 months if I want to get a monthly depreciation rate. And then so I'm going to depreciate it $5,000 a year, or $10,000 a year. Okay, makes sense? So that's an estimate. I don't know exactly how much that fixed asset got used up, so I estimate how much it used up based on how much I estimated it was going to be useful to my business. And we do that based on historic. Okay, historically, we drive a tractor for 5 years or whatever. Okay, makes sense? All right, so that's estimates. And then periodic inventory. We'll look at the entries for inventory.
Let's say it's a new company and they don't have any history. What do they do then?
I look at others, yeah, or ask your accountant,
Yeah.
because they probably have experience. But it's typically, you know, like a tractor and trailer. You know, IRS rules, you can depreciate a tractor for 3 years for tax purposes.
Wait, a truck now. So you mean
A truck tractor, a semi tractor, not an agricultural tractor.
Yeah.
Farm tractor. A farm tractor you depreciate over 7 years. Mm-hmm. Yeah. But a tractor and trailer, 3 years, because it depends on usage. So, I mean, I've seen people that a truck have a tractor on the road for 40 years and it's got over 1 million miles on it and still rolling. And I've seen people blow them up in 1 year too. So you just don't know. So historically, how long does a tractor last?
Probably a John Deere tractor. John Deere tractor.
A John Deere? Well, that would be I don't think John Deere makes semis, but they do make agricultural tractors. Farm tractor, yeah. But now Peterbilt makes a good tractor, and let's see, who else? International makes a good tractor. So several good ones.
John Deere.
John Deere's good. That's right. And see, I have lots of farming clients, so I'm pretty familiar with all that. All right, so deferrals is when we're recognizing an expense. So prepaid expenses are a deferral, okay? Because we know it's going to become an expense, but it isn't an expense yet. We're deferring recognizing it as an expense, all right? So like supplies, we bought those, we put them in the closet. We know they're going to eventually be used up, but they're not yet, so they're called prepaid expenses, okay? It's never going to be sold, it's going to be used. So that's why it's called a prepaid expense. Same thing, insurance. Insurance is always an asset when we buy it, right? Because insurance companies always make you pay up front. They don't let you pay for the insurance after the fact, because if you didn't have an accident, you're not going to pay for it, right? So you always buy insurance in advance, so it's always prepaid when you buy the policy. And we know it's going to turn into expense. We're not going to sell the policy, so it's never going to turn into cash. It's going to become an expense when it gets used up. So prepaid insurance is a prepaid expense or a deferred expense. Okay, does that make sense? So we're deferring, recognizing it as an expense until it gets used up. Deferred revenue, somebody pays us in advance. What do we call it?
Unearned revenue.
Unearned revenue. So if somebody pays me in advance for an accounting job, then I have somebody's money that doesn't belong to me. So it's in my bank account, but it's a liability because I owe them either their money back or what they paid for, right? So I'm going to defer recognizing that as revenue until I have earned it. Because remember, revenue is only recognized as it's earned. So basically, revenue can be recorded three different ways, right? I got paid as soon as I finished the job, so debit, cash, credit, revenue, right? Or I'm going to get paid in the future, debit, accounts receivable, credit, revenue, right? Or I got paid in advance, so when I got the money, debit, cash, credit, unearned revenue. And then when I earned it, what's the entry? When I actually finished the job, what's the entry?
Credit.
Good guesses. So where did I put it when I received it? I got paid in advance. Accounts receivables when I'm getting paid in the future.
You're gonna debit unearned revenue.
Hot damn. Debit, oops, I said that on video. Debit unearned rent or unearned revenue because you no longer owe it to the client, and credit revenue because you've now earned it. Okay, does that make sense?
Yeah.
So when you are earning revenue that's been deferred, now you're going to recognize it as revenue. So debit unearned revenue, credit revenue. Good, very good. Okay. So we talked about accruals. There's the definition. So these PowerPoints, of course, stay out there, but I've got it written up here as well. Accrued expense, incurred, not yet paid. Accrued revenue, earned, not yet received. And there's the effects. Accrued expense always increases an expense account, increases a liability because it's incurred, not yet paid. And revenue always increases an asset, accounts receivable, and increases the revenue. Okay, estimates, depreciation, and bad debts. We just talked about those. So when, remember matching principle, what does it say? We match the expenses
With it.
in the period
In the
with
period,
the
yeah.
revenue,
The revenue,
right?
yeah.
So expenses is everything that it costs us to earn that revenue. So if we want to match the bad debt expense, what is bad debt expense? Yeah, it's the allowance.
Yeah.
It's the accounts that are going to go bad. So we allow for them or we match them in the period with the sales. So for example, if we sold $100,000 worth of stuff and we believe that 1% of those accounts are going to go bad, that's $1,000. So we need to record $1,000 in the allowance account so that we show $99,000 of net realizable value, right? What's the entry to record that allowance?
Debit.
Now, what the allowance account is a contra, right? So what's its normal balance? It's a credit,
Is it credit?
right? Because what's it contra to? Accounts receivable. Accounts receivable is an asset which has a normal debit balance. So your allowance account has to have a normal credit balance because it's a contra asset account. So you're going to credit the allowance account in order to bring accounts receivable down to net realizable value, right? Accounts receivable is a debit, the allowance account is a credit. The two of them netted together equals net realizable value. So when we estimate how much is going to go bad, we're going to credit the allowance account. What are you going to debit?
Bad debts expense.
Bad debts expense. Because the part that is not going to be received is actually a cost to doing business, which is an expense. So whenever we estimate that $1,000 that's not going to be collectible, debit bad debt expense, credit the allowance account. Make sense? Okay. What if customer later comes back and pays? Do the opposite. Put it back on the books. So you're going to debit accounts receivable, credit. Well, when you write it, actually, I skipped a step. So we allowed for the fact that the account was going to go bad. What's the entry when it goes bad? Bless you. When it goes bad, we want to get it out of accounts receivable, right? Credit accounts receivable. What are you going to debit? Allowance for doubtful accounts, because you've already allowed for the fact that some of those are going to go bad. So you're going to debit the allowance account.
That's what we figure out, where did the bad debts expense come from? Why did we debit that?
So the only time you're going to hit bad debt expense is when you're estimating how much is going to go bad. When they actually go bad, you're going to debit the allowance account. Okay, does that make sense?
Yeah.
All right, so if the customer comes back later and pays, what are you going to do? You got to put it back on the books first.
Debit accounts receivable.
Debit accounts receivable.
Credit bad debts.
No. Only time you're going to touch bad debt expense is when you estimate.
Credit allowance.
Credit the allowance account to put it back on the books. Then they pay you, debit cash, credit accounts receivable. Does that make sense?
Yeah.
Good. Good. All right. So you understand that process. Yay. Y'all are so smart. Okay, so we talked about this, how to calculate depreciation. That's the estimated using up of a fixed asset. Who can remember the 3 criteria for a fixed asset? Long term, being used, tangible, okay? You touch it, okay? And of course, if it's not tangible, can't wear it out, right? So if it's like accounts receivable, can't wear that out because it's not tangible, all right? Insurance policy can't wear it out so it doesn't depreciate. It gets used up over time. Okay, does that make sense? So it's got to be tangible to depreciate. But land is tangible, but it doesn't depreciate. Why? Land? Okay, don't make any more of it, right? Can't blow it up, can't carry it off. Can't blow it up, can't carry it off. So land don't depreciate. You can't use it up. Of course, you can destroy it by putting chemicals and crap in the dirt, so you can actually destroy it, but the EPA will make you clean it up. Okay, there's bad debts. We talked about that. Let's see. All right, periodic inventory. This is where we got before. How am I doing on time? Okay, I'm good. So inventory. What is inventory? Everything the company owns.
In the regular course.
That is
That's available for sale in regular.
Available for sale in the ordinary course of business. It sounds like he's heard me say that a few times, doesn't it? Okay, so you need to know that, right? You need to understand that. And that last caveat, ordinary course of business, is important, because if we're selling a delivery truck, that's not normally what we sell. So that's not sales. When we sell it, that's a gain or a loss, right? That's a sale of an asset, and that's either a gain or a loss, okay? But sales is when we sell inventory in the normal, ordinary course of business. Okay, so inventory is everything we have that's available for sale. When inventory gets used up, it becomes, when we use up an asset, it becomes a what? It's expense. So when inventory gets used up, i.e. sold, it becomes what? Cost of goods sold. Very good. You understand all this stuff. I love it. Okay. So in a periodic inventory system, the reason it's called periodic, because we periodically count the inventory in order to determine our cost of goods sold. Who remembers the formula for cost of goods sold?
Yeah, or in the factory.
It doesn't matter. It's the same. What's the formula for cost of goods sold?
It's beginning cost of goods made.
It's beginning inventory, but in a factory, it's finished goods inventory. Okay, plus manufactured. If you're in a factory, if you're buying it, it's plus purchases minus ending inventory, or if you're in a factory, ending finished goods inventory. Of course, we're studying cost accounting at the same time, so we need to know both formulas. So if we're a merchandiser, which means we buy a product that's already been manufactured and mark it up and sell it at a profit. The formula is beginning inventory, because you only have one, plus purchases because you're buying that inventory, minus ending inventory equals cost of goods sold. Okay, does that make sense? Beginning inventory plus purchases minus ending inventory equals cost of goods sold. If we're in a factory, it's beginning finished goods inventory, because we don't sell any of the other inventories. We don't sell materials, we don't sell work in process. We only sell finished goods. So beginning finished goods plus, because we didn't buy that product, we manufactured it, the cost of goods manufactured minus ending finished goods inventory equals cost of goods sold. Okay? So what we're doing is we're periodically counting the inventory and calculating our cost of goods sold via that formula. Okay? That's what we call a periodic method, because the only way we know cost of goods sold is because we periodically counted it. Okay, the alternative, we're not going to talk about the alternative yet. We'll talk about that in a future chapter. Do I? Yes. Okay, so let's go ahead and talk about it. So the alternative is what we call the perpetual inventory method. What does perpetual mean? Continually or always. Okay, so you go to Walmart, okay, or the grocery store, wherever, and every time they run an item across the little scanner and it goes beep. So I always tell students, I stand there because I'm an accounting professor. So I'm thinking, what is the little beep doing? So what's the computer doing when the little beep happens? Debit cash, because I'm going to pay cash because I'm a redneck. Credit sales, right? Debit cash, credit sales to record the sale. Also, because Walmart uses a perpetual inventory system, it's going to make a second entry to relieve the inventory. So it's going to make an entry to debit cost of goods sold and credit inventory for the cost of whatever I bought. Because the computer system, because they keyed it into an inventory system, knows exactly how much they paid for that comb or toilet paper, whatever I bought. It knows how much that Charmin toilet paper cost, so it immediately records the entry to debit cost of goods sold and credit inventory. Does that make sense? So we're going to study different methods for calculating inventory, and they're FIFO, LIFO, average costing method. So we're going to study those and how we make those calculations. But with a perpetual system, it automatically makes those entries every time we record a sale. So we don't have to wait until we count the physical inventory in order to determine cost of goods sold. Now, it takes a fancy-ass computer system to do that, right? Because it's going to have to keep track of all those tens of thousands of items that are on those shelves and know how much the original cost was. Does that make sense? But if I'm a little mom and pop grocery store, and I have lots of clients that are just little stores, and at the end of the year, when I'm trying to calculate cost of goods, they'll tell me this is how much crap I bought during the year. So that's my purchases. I know what the inventory was last year because I did the tax return, right? So I know what beginning inventory, I know what purchases. So I ask them, did you count your inventory? How much did you have left at the end of the year? And my purpose is to calculate cost of goods sold, because that's going to be a deduction. That's an expense. All right. So I take beginning inventory plus purchases minus ending inventory equals cost of goods sold. But Walmart, of course, don't have to do that, because every time they sell something off the shelf, they record the entry to record cost of goods sold. Does that make sense? Okay. So it's periodic method or perpetual method. Okay. And then we talked about an adjusted, well, we didn't really talk about it, but so in a computer system, we don't need to print an adjusted trial balance necessarily. So we print an unadjusted trial balance, and that's when we look at it and say, what adjustments do we need to make, right? We make those adjustments, and then we have an adjusted trial balance. And then from that adjusted trial balance is where we produce our financial statements, okay? Remember when you did the big columnar sheets, and you had your unadjusted trial balance, and then you put your adjustments in there, and then you had to calculate your adjusted, and then you put whatever went into the income statement column and the balance sheet column. We may do one of those just for shits and giggles. Whoops. Anyway.
Beep it out.
Beep it out of the video.
Beep some stuff out of the video.
Okay, so all right, we talked about this. What's on the income statement? All right, and of course, everybody knows the definition of current, right? What's a current asset? Everything that's going to
You use that
or turn into cash within
in one fiscal year or period.
or one operating cycle, whichever is longer. Okay, and the reason for that, I always use the example, space shuttles. If I'm building space shuttles and it takes me more than a year to build one, then my operating cycle may be more than a year. What's an operating cycle? Cash, buy inventory, sell it, create an accounts receivable, goes back to cash. That's an operating cycle. All right. So if I'm building space shuttles, I might buy the materials, build the space shuttle, and that may take me a year. I sell my one space shuttle, create an accounts receivable, and collect it back in cash. If that takes more than a year, then current's more than a year. But for 99.999% of businesses, you're going to sell your inventory many, many times during the year. Okay, so operating cycles are much shorter than a year, so therefore current is 1 year. Okay, all right, and of course non-current is going to be anything that lasts more than a year. Current liabilities is everything that we're going to pay within 1 year or one operating cycle. All right, so there's a balance sheet. Statement of cash flows, remember this? It's got the 3 sections. You can name me the 3 sections of the statement of cash flows. Can you do it, Jerome? Sounded like a moose, didn't he?
1 second.
Do you have moose? Is it moose or meese? If you're talking about plural. Yeah. Do you have moose in South Africa? No.
Your cows.
You have cows, like cattle, like we have here.
We had a lot.
A lot of cows.
Like, yeah, on the farm.
So you're killing the atmosphere with all the methane gas, right? Because you know they do fart.
We killed a lot of them, though.
You kill a lot of them and
Yeah.
eat them.
I know.
They're like 500 on the farm.
That's a lot of cows.
I think like investing's got to be one of them.
Right, investing section, which is where we record all the buying and selling of long-term assets. And then the operating section is all the cash from
And then the
operations.
bottom is
Financing.
Give me that.
Yes, okay. So that's when we borrow money, pay it back, and issue stock and pay out dividends. So I have a little thing that I do, which I think is kind of cool. And I kind of take credit for it. Actually, no, I can't take credit because I actually read it somewhere, but I have this super duper memory. And you know, that's a key to intelligence, is having a good memory. And I think a key to having a good memory is getting enough rest. You guys don't sleep enough. See, it's my goal to get all the beauty sleep I can get. My goal is to get 8 hours. And I think that a human really needs that. If you want to be happy and healthy, work 8, play 8, sleep 8. That's why they made 24 hours in a day. You divide it evenly. Work 8, play 8, sleep 8.
Rule of thirds.
Do what?
The rule of thirds.
The rule, is that a rule?
I mean, it's a rule of photography also, but
Really?
I've heard of a rule of thirds, yeah. 8 sleep, 8 work, 8.
Yeah, so that makes you happy, healthy, wealthy, and wise, right? Okay, but anyway, so for a statement of cash flows, I like to go operating activities, that's the first one. And then investing activities. And then financing activities. And I have to remember to turn around and say that to the computer because I'm not wearing my headset. I need to go get it. So operating activities, investing activities, and financing activities. So in your operating activities section, you're going to start with net income. If we're doing the indirect method, okay, we're going to start with net income. Everybody remember that? And you add in depreciation and amortization. Remember that? Depreciation and amortization. And you're going to add in losses and subtract gains. So plus losses minus gains. Because remember, losses and gains is from selling long-term assets. So they're actually going to be down here. So if we start with net income and we have a loss or a gain in that, we have to get rid of it because it's going to be down here in this section. Okay, remember that?
Wait, so is that plus?
So net income plus depreciation plus amortization expense, depreciation expense, amortization expense, plus losses minus gains.
But depreciation and amortization is gonna be like a negative number?
Well, they're going to be expenses on the income statement, but they're not an outlay of cash, right? Because they are just the using up of a fixed asset. So in order to calculate the cash flow from operations, we add back depreciation and amortization because they're not an outlay of cash.
Yeah, okay, I
Okay.
see.
Okay. And we add back losses and subtract gains because they're going to be moved down to this section. All right, does that make sense? Okay, so we start with net income, we do this mumbo jumbo, and we also consider the change in current assets and current liabilities. Okay, so if accounts receivable goes up, that's going to be a use of cash. If it goes down, that's a source of cash. Accounts payable goes up, that's going to be a source of cash. If it goes down, that's a use of cash. So the change in current assets and current liabilities goes in this section. Does that make sense? The change in current assets. If prepaid insurance goes up or it goes down, that's going to go in this section. All right? If supplies goes up or goes down, it's going to go in this section. All right? So any change in current assets and current liabilities. Any change in long-term assets, whether we bought them or sold them, is going to go in this section. Long-term assets. Make sense?
Yeah.
Long-term debt goes in this section. And owner's equity goes in this section. If we issued stock, if we bought back treasury stock, if we paid out a dividend, goes in that section. So all of the accounts, all the balance sheet accounts are represented here. You just have to figure out what section. So if it's a current asset or current liability, the change in that account goes here. If it's a long-term asset, it goes here. If it's a long-term debt or an owner's equity account, it goes here. Does that make sense? And you end up with your change in cash, whether it went up or went down during the period, and then you add in your beginning cash, and that gives you your ending cash, which balances to your balance sheet. Okay? And by looking at this statement, you can see how much income or how much cash was provided by operations, how much was either provided by investing or used in investing, how much was provided by financing or used in financing, what's the change in cash, and what's your beginning and ending cash. So what you're doing, you take your income statement, which is on accrual basis, and you convert it to cash. So this statement shows you how much you, at your operating activities, actually provided in cash during the period. Does that make sense? I love statement of cash flows. It's a beautiful thing.
What's in circles again?
This is the totals. Total cash provided by operating activities or used in operating activities. If we're operating, maybe if we're a new company and we're just getting started, we're not getting cash out of operations. It could be that we're operating at a loss, and we may be using debt or equity to finance that loss. So it could be a positive number, it could be a negative number. I mean, on a mature company, it's definitely going to be a positive number because you're making money from operations. If you're Walmart and you're selling crap, you're going to get a positive cash flow from selling that crap. And then you're going to spend some money on long-term assets. So if you're buying equipment, you're buying lands, building, if you're investing in like other companies, like we're studying in advanced class, you buy stock in another company, that's going to be a long-term asset. It's going to go in this section. So we can see if a company has got long-term monies to invest, okay? If you're issuing new debt or if you're paying off old debt, we can be able to tell that by looking in this section, okay? Or if we paid a dividend, it's going to be right here because that's an owner's equity account, right? If we issued new stock, or if we bought treasury stock. Anybody know what treasury stock is? Treasury stock. It's actually a contra equity account. It's us buying back our own stock and putting it in the treasury. Okay, because once you issue stock, it's issued forever. You can retire it, but typically a company buys their own stock back. So if they, if they have a stock issue and then suddenly they don't need that many investors any longer, especially if somebody is a majority shareholder and takes over and they want to buy back some of the stock, Companies do that sometimes. When they buy it back, it goes on their balance sheet as a negative number in the equity section because it's treasury stock now. The company bought their own stock. Does that make sense? If you buy stock in another company, it's an investment. If they buy their own stock, it's a negative equity account called treasury stock. Okay? So that's how I like to remember statement of cash flows. It makes sense. It's logical, and you know where to put stuff.
What's the LTV, long-term?
Long-term debt, long-term assets, long-term debt, and owner's equity. We talked about closing entries. We're good with that. And there's what they look like. And of course, they use the income summary account, which I've always thought that was ridiculous. Why didn't you just go straight to retained earnings? And of course, in the computer system, we do. You just go straight to retained earnings. So no income summary account. That was back when you used big green sheets and stuff. Okay, we talked about the worksheet, the big columnar worksheet to prepare the financial statements. Oh, reversing entries. We need to talk about this. So sometimes we accrue stuff just for the purpose of preparing financial statements. So for example, if we, okay, we have a long-term debt. So if we owe money, it's costing us what? We borrowed money at the bank.
Interest.
Good, interest, okay. So at the end of the year, remember, we have that matching principle that says match the expenses with the revenue. So if we're operating with debt, then that debt is costing us interest. We have to put that interest in the period because we use that money to finance operations or equipment or something, right? So that's a cost that has to get matched in that period. So sometimes we will accrue that interest. What would the entry be to accrue that interest?
You're gonna debit interest expense?
Yes.
And you're gonna credit?
What is accrued expenses? Oh, I erased it.
What is accrued expense?
What are they? What's the definition?
Expenses.
That you've incurred, not yet paid.
Okay, so what's your credit going to be?
That's payable?
Yes, some payable. Good. All right, so now what's your entry? So if you remember the whys, you can rebuild the whats.
Yeah.
So remember what it is, and then you can tell me what the entry is. Now what's the entry?
So you're gonna debit.
What's the entry to accrue that interest? So it's
gonna be debit interest expense and you're gonna credit accounts payable.
not probably accounts payable, probably interest payable. Good. Makes sense? Remember the whys and you can rebuild the whats. And that's so true in accounting because if you can remember the concepts, you can apply it to all the different situations. That's what we're going to learn in this class. Is all the different situations that we're going to encounter. How do you measure it and record it and present it? That's what this class is all about. All right? Okay, so if we accrued that interest, and we said it was interest expense, say $1,000, and interest payable, $1,000. And normally, maybe we're making a monthly payment on this debt, okay? So when we make that payment, maybe in the January payment, the payment was $1,200. So we're going to credit cash $1,200. And we're going to debit interest for the interest portion. So say the interest portion is the 1,000, and we're going to debit the note payable for the principal portion of the payment. Does that seem reasonable? That we had a payment, it was $1,200. And in the beginning, interest is going to be more than principal, right? Because when we make a payment on a debt, we pay the interest first. When you go to the bank and you make a payment on your car, you hand them $1,200 to make that payment, they're going to take the interest out of it first, and then the rest of the money they're going to apply to the principal debt. Okay, interest gets paid first. So then the next month, when you make a payment, they're going to calculate the interest based on the new balance of debt. And we'll do amortization schedules. That'll become more clear then.
So the interest will go down the whole time?
Interest will go down every time you make a payment,
And your
yes.
principal cost will also go up then?
No, your principal,
No, it stays the
well,
same essentially, but your interest is getting paid first, so it'll never get touched until interest is totally like
right. So
gone.
interest is paid first. So your principal goes down every time you make a payment, but only by the amount that's remaining. So your principal goes down. So the next month when you calculate the interest, it's going to be based on the new principal. So your principal is going to go down each month. So your interest the next month is going to go down because the principal went down last month.
Let's say you have a payment, a monthly payment, the cash payment, $1,200
Mhm.
that you pay.
Mm-hmm.
And your interest is going down every time.
Mm-hmm.
Won't that, so if your interest is not $1,000, let's say it's $900 the next one, won't the note principal be 300 then?
If your principal is going down, then your interest is going to go down and your principal payment will go up. Yes, I see what you're saying. So the next time you make a payment, it will go up.
Yeah, because it has to be credit and debit has to match, right?
Yes. Credits must equal. I thought I had an amortization schedule out here that I could show you to show you how that works. Okay, we'll cover that later, but we will do amortization schedules where you will see the interest and the entry as it goes down and how that works. You'll see that. Oops. All right, so we're talking about reversing interest. So, so we made this entry at the end of the year because it was December 31st and we hadn't made the payment yet, so we hadn't recorded that interest expense. So now, January the 5th, we made the payment. So after we've made this accruing entry. And this is how we normally make our monthly payment. We key it into the computer, make a payment to the bank, computer automatically debits interest, debits principal, and credits cash. So that's just the normal entry. If we don't want to screw that up, right, we've already recorded the interest for that $1,000. We had to do it at December 31st in order to get it in the correct period. So if we don't want to double record that same interest expense, we reverse this entry. So we're going to reverse that entry January the 1st by debiting interest payable and crediting interest expense. Okay? And all we've managed to do was get this $1,000 into December where it belongs, because that was a December payment, or it was a December expense. We just are not going to pay it until January the 5th. Does that make sense?
But won't you reverse it on January the 5th then?
Well, we want.
Reverse it on January the 5th?
Well, we typically reverse entry, you reverse it at the beginning of the next year. So if you accrued it on December 31st and you want to get rid of it so that it doesn't mess with your normal entries, you just accrued it just for the purpose of moving it into the December period so that you can get on a financial statement. So then, otherwise, if you don't reverse it, you're going to have to remember to debit interest payable here instead of interest expense. Okay? And typically, well, your computer system's not going to know to do that. Your computer system is programmed debit interest expense, debit principal, credit cash whenever you make a payment. So if you don't want to mess that system up, you reverse that accrual through a reversing entry. Does that make sense? And it's only going to be accrued expenses and accrued revenues that you will reverse. So like depreciation, you're never going to reverse, right?
Yeah.
Yeah. So that's an adjusting entry, but it's never going to be a reversing entry. Okay. Salaries, wages. So that's another one that you might reverse. Okay. Because when you key in all those hours for the employees, the payroll system is going to make the journal entry. It's going to debit payroll. It's going to credit all the liability accounts. It's going to credit cash for the payroll. So at the end of the year, you typically hold your employees back, a week to 2 weeks Okay, so at the end of the year, you owe some payroll that you haven't paid yet. What's the entry to accrue payroll that you haven't paid?
To accrue payroll that
Accrue
you haven't
payroll.
paid. Wages, wages expense would be credited, debited. Wages expense would be debited and wages payable would be credited.
Yes,
Yeah.
okay, because you're trying to get that expense in the correct period. You're matching it with the revenue. Those pesky employees, hopefully they worked, maybe they did. So you need to get that expense in the period when they actually worked. You're matching it in the correct period. So you debit wages expense, credit wages payable. Then when the payroll gets paid on January the 3rd or whatever, it's going to do the same entry. It's going to debit wages expense and credit all the liability accounts. So you're going to double do your wages expense if you don't reverse that entry. So you're going to, January the 1st, what's your entry going to be? You're going to flip it, debit wages payable, credit wages expense to reverse that, and then your computer is going to make your normal entries. So especially, we talked about bookkeeping going away, and it's going to go away because computers are able to make those entries. So in order for us to do that effectively, and actually some software packages, it will, when you make an adjusting entry, there might be a little checkbox that says, should I reverse this? So if you hit that box, computer will automatically make a reversing entry on the very next day. So if I make an accrual on December 31st to debit wages, expenses, and wages payable, and I hit the little box that says reverse, then the system's going to automatically make another entry on the very next day, January 1st of the next year, to do the opposite entry. So some software has that. And I really should get me a software package, either mine or somebody else's, and use in this class. I'll work on that. Okay, so that's reversing entries. How am I doing on time? I'm out. All right, so there's an example. So they use salaries as an example. So subsidiary ledgers, we'll talk about those a little bit as we go on. So like if we're talking about accounts receivable, then we may have a subsidiary ledger of all of the customers, so that the accounts receivable account in the general ledger is called a control account. And then in order to see who all the customers are that we owe to would be a subsidiary ledger. Okay. And same thing with accounts payable. So accounts payable in the general ledger is the control account. That's the total that we owe to everybody. And a subsidiary ledger would show all the different vendors that we owe. Okay. This is really not applicable anymore with computer systems, although this is my source. I told you in my software that I wrote, my sales journal would be AR. So if I wanted to print out a sales journal, everything that I keyed in or that came out of the invoicing system, the accounts receivable system, would have a source of AR. So I can print a sales journal. I'm just not going to key a sales journal. It's going to come automatically from the accounts receivable system. The purchases journal is going to be AP because that's coming out of the accounts payable system. Cash receipts, that's just going to be, CR is my source, and cash payments is going to be CD, cash disbursements. So I can print these journals, but we don't use special journals anymore. It's all just done by computer with the source code. We talked about cash basis. Yay. So that's chapter 3. So what I would love you to do on Thursday is to work on that chapter 3 quiz. And all that's just going to reiterate all this stuff's going to ask you about 70, 80 times, right, Henny? All these different questions in multiple different ways to help to make sure that you understand. And that gets us up to where we need to be and ready to study new material, because this is a review. Okay? All right, and I recorded this. I'm going to post it on ULearn in case you want, if you're bored or you just missed me over the weekend and you want to watch me say this all again, you can do that. Just kidding.